Hello and then welcome to CN Professional Institute. We are still on Ifrs 15, revenue from contract with customers. In the previous video, we looked at step 5, recognize revenue as and when performance obligation is satisfied. So we look at performance obligation at a point in time and then performance obligation over time. And so we looked at indicators of control, what shows as a control. We looked at performance obligation over time, where we measure the progress and then we apply the progress on the total contract price to record revenue. We looked at what we do, okay, or what happens when there's overall contract loss called the onerous contract. Then we also looked at what to do when progress cannot be determined. How much revenue do you record? We looked at all these things, right? In this video, we are going to solve some questions, 4 or 5 questions, and we look at other areas. We are going to look at bill and hold, consignment inventory, still with the right to purchase and other areas. Okay, we'll also look at agency and principal. How do they record revenue? And then we'll wrap up IFRS 15 and look at that standard. Right. So let's solve these questions and then we proceed. Okay. So we have example 1 here. So example 1. So example 1. It is the following information relates to construction contract. So we have the contract price, we have cost to date, estimated cost to complete, estimated stage of completion, and it says what amount of revenue, cost, and profit should be recognized in the statement of profit or loss. And then B, take the same contract, but now assume that the business is not able to reliably estimate the outcome of the contract, although it is believed that all costs incurred will be recovered from the customer. What amount should be recognized for revenue, cost, and profit in the statement of profit or loss, right? Okay, so we have this question here that we have to work on. Okay, so we have them here. So let's start. We says the first thing we do is we do what? We compute what we call overall profit or what? Loss, right? So the first thing we do is we look at overall profit or loss. Overall profit or loss, right? Okay, why do we do that? We've learned the reason for doing that. We said sometimes there could be what? Contract loss, overall contract loss, and that will lead to what we call onerous what? Contract, right? So we first of all determine if there's overall contract loss. If there's overall contract loss, then we apply the rules. I mean, to recognize all the loss immediately, right? Okay, so what's our contract price? So the contract price, so what's our contract price? Is in the question 800,000. Good. Then we have total cost. So we compare the total contract price with what? The total cost. Okay. Now what's the total cost? The total cost will be what? The cost to date plus the cost to what? Complete. Okay. That will be our total cost. So it will be this 320 plus the 280. That's the total what? Cost. So we put the total cost together. I mean, we put the cost to date plus the cost to what? Complete. And that should give us 600,000. Okay. So our total cost is what? 600,000. So when we deduct, what do we get? We are going to have profit. We have overall profit. Overall profit of how much? 200,000. So this overall profit. So this contract is not onerous contract. So we don't have to record the overall loss. Okay, so this contract is profitable. Then we said step 2 is we measure the progress. We looked at this in the previous video. How do we get the progress? Here, the progress has already been given to us. Are you following? The progress has already been given to us. So we don't have to go and do anything. The question said the estimated stage of completion is what? 60%. So 60% is what? The progress. Okay. Then we go to step three. Step three. Step three, we are going to our statement of profit or loss. Our statement of profit or what? Loss, right? And we say in the P&L, we record revenue. So our revenue is equal to, we said we apply the progress rate by the total contract price. Don't forget, we apply the progress rate on this 800 what? Thousand to get the revenue. Okay. So we are going to have 60% of the 800,000. Okay. And that's what we are going to record as the revenue. Okay. So as simple as that. So we said revenue will be 60% of 800. Let me bring it here. And that will give us an amount of 480,000. That should give us 480,000. Okay, 60% of 800 should give us 480,000. So that's the revenue that we're going to what? Record. Let's look at the cost of sales that we record. Cost of sales. And we said previously, we were recording, to record the cost of sales, we apply the progress rate, the 60%. We would have applied the 60% on the total cost. So we would have applied the 60% on this 600,000 here, on this total cost of 600,000 here. That's how we used to do it. We normally apply the progress rate on the total contract price to get revenue. And we also apply the progress rate on the total cost to get cost of what? Sales. But I told you there's a change, right? So now we don't apply the progress rate on total cost to get cost of sales again. We only take the cost to date as cost of sales. We take cost to date as cost of sales. So if you look into the question, cost to date is 320. So our cost of sales will be what? 320. I hope you're following. So we have 320,000 as our cost of sales, and then our profits, if you deduct, we are going to have profits of 160,000. We're going to have profit of 160,000. So you can be punching alongside and then be comparing the figures. Okay. So this is that for the E. Very simple. Okay. The revenue, apply the progress rate by the total contract price. For your cost of sales, just pick your cost to date as your cost of sales and you have your profit. Let's look at B. Okay, so let's look at B. So B says, it is now we should assume we should what? Assume the same contract. Okay, by this time, the business is not able to reliably estimate the outcome of the contract. So we said if we cannot estimate the progress, okay, if we cannot estimate the progress, if we cannot estimate the outcome, okay, of the contract, then we have to record revenue equal to our cost of sales, or we have to record revenue equal to our cost to date. If you remember, I said that, right, in the previous video when we were looking at the figures that will go to P&L and then the figures that will go to financial position. So we said where we cannot measure the progress, or where the contract, okay, the outcome cannot be determined, cannot be reliably what? Estimated, then we use our cost to date as our revenue. Okay, and we use the same, so our cost of sales here will be the same, 320, and we record 0 profit. Don't forget that. If we cannot determine the progress, then the standard says we should record revenue in a way that our cost to date, or our total contract cost, our contract cost, the cost we've incurred to date will be recovered or will be covered. Okay, so we have to record the revenue in a way that our cost to date or our contract cost we've incurred to date will be what? Covered. Meaning you have to record cost of sales equal to what? Revenue. Okay. So it means that we are going to pick our cost of sales or the cost to date as the revenue. So the standard said we should record zero profit if we cannot estimate the progress or if we cannot estimate the outcome of the contract. So you record revenue equal to your cost to what? Date. So your revenue will be the same as your cost to date, leaving you with zero profit. So that's all. Let me explain to you how I would have gone by the old way. Here, when you get to revenue here, that's what I've said. Okay, that if we're using the old way, when you get to this place here, when you get to the revenue here, when you get to this revenue, I said your revenue would be the normal way, 60% of the 800, which will give us 480,000. But the cost of sales here, it wouldn't have been 320, it wouldn't have been cost to date. We would have applied the 60% on the total cost. What the total cost? 600,000. So we would have applied the 60% on the 600,000, giving us what? 360. So if we're using the old method, our revenue would have been the normal 480. Our cost of sales would have been 360, leaving us with a profit of what? 120. Are you following? So we are now looking at new way of presenting this as introduced by ACCA. Okay, so let's see this one here. So example 1. Okay, so let's go to example 2. Let's look at example 2. Example 2. Okay, so example 2, it says CL Limited is a contractor. Sorry, CL Limited, a contractor, is constructing a building for a customer and has the right to regular payments as the work progresses. The following information are provided. So you have the contract price, 2,500,000, work certified 1 million, cost to date 900, estimated cost to complete 1,100,000. The policy of CL Limited is to measure progress using an output method based on work certified to date. Required, calculate the revenue, cost of sales, and profit to be recognized in the statement of profit or what? Loss. So here they are using the output method. And I say with the output method to get the progress, it is work certified over total contract price. And I'll give you a progress. That's the only thing that changes. So as usual, the first thing is we have to get our overall profit or what? Loss. And the reason is to verify if the contract is onerous, whether it is profitable or not. So overall profit or what? Loss. We look at that. So how do we get the overall profit or loss? We compare the total contract price with the total cost. So contract price, what's the contract price? 2,500,000. Then total cost. Total cost will be cost to date plus cost to what? Complete. Okay. Cost to date plus cost to what? Complete. So cost to date is what? 900,000. Cost to complete is what? 1,100,000. So when you put the two together, if you put the two together, that will be your total cost. Are you following? So in this case, your total cost will be 2 million. If you put the two together, you get 2 million. So we bring 2 million here, and then this is what we're going to have. So you could see there's profit, there's overall profit. Okay. So this contract is on, it's not on us. There's overall profit of what? 500,000. So this contract is not on us. Then step 2 is we go and apply what we call what? Our progress. Are you following? So step 2, our progress. Okay. And then how do we get our progress? So you write it down. We said our progress here, if you're using the output, the question we should use output. If you're using the output, it is work certified divided by what? The contract price. Okay. So work certified over the contract price by 100. Are you following? Okay. So if you come here, what is the work certified? This is the question. Here, the work certified is what? 1 million. So you come here, work certified is what? 1 million divided by the contract price. The contract price is 2,500,000. Okay. Then you multiply your answer by 100%. Okay. And that'll give you, so 1 million divided by 2,500,000 by 100 should give us 40%. So we have 40% as the progress. So we are done with the progress. We go to step 3. Step 3 is where we are going to record our revenue. Okay. So step 3, how much revenue do you record in your books? We said revenue, we apply the progress rate here. Okay. So what's our progress rate? 40% times. So we apply 40% by the total contract price. What's the total contract price? 2,500,000. Okay. So 40% times the 2,500,000. Okay. And that would give us 1 million. So we have 1 million as the revenue. We are going to record 1 million. So we have 1 million as our revenue. Okay. Then cost of sales. We said previously, cost of sales would have multiplied the progress rate, would have multiplied the 40% by the total cost, which is the what? The 2 million. That's how we used to do it. We have multiplied the 40% by 2 million. Are you following? So previously we applied the progress rate on both the revenue and the total. We applied the progress rate on both the total contract price and then the total cost to get revenue and cost of sales respectively. But now we are just taking the cost to date as our cost of sales. So if you check the question, our cost to date is 900,000, right? So 900,000 is what we are going to record as the cost of sales. Okay, the cost to date, that's the 900,000, is what we are going to record as our cost of sales. Okay, so when you deduct, we are going to have what as the profit. Okay, so just deduct 1 million minus 900,000, and that will give you your what? Profit. Are you following? So we are going to have profit of what? 100,000. We're going to have profit of what? 100,000. So as simple as that. So our profit is what? 100,000. So that's how we go about this. Very simple. We said the only thing here is that with example 2, we are using work certified over total contract price. That is the output method. Okay, so we have to determine our own progress. Go to the question, what's the work certified? 1 million. Contract price is 2,000,000 what? 500, right? So divide it and then get your progress. Then you come and apply the progress on the total contract price to get the revenue. And then when you go to the cost of sales here, you pick cost to date as your cost of what? Sales. You pick cost to date as your cost of what? Sales. Okay. So that's with question 2. Okay, here there's we can't basically do the financial question, but we'll look at it. Okay, we'll look at this things in detail. We'll look at them in detail. Let's look at question. Let's look at example. Let's look at example 3. Example 3. Okay. So with example 3, okay, let's solve example 3. So okay, so example 3, let's do it on a fresh page. So we have example 3. So example 3, it says on 1st January 2024, Latifa entered into a contract with a customer to construct a specialized building for a consideration of what? 10 million. Latifa is not able to use the building themselves at any point during the construction. At 31st December 2024, Latifa had incurred cost of 6 million. Costs to complete are estimated at 6 million. Latifa measures progress towards completion based on cost incurred. At 31st December 2024, Latifa had received 3 million from the customer. Required. How should the transaction be accounted for in the year ended 31st December 2024? Okay, so here, if you look at it, the consideration is 10 million. That's the contract price. Cost to date is what? 6 million this year. Cost to complete is also what? 6 million. And they use, and then they have received, it says Latifa has received what? 3 million from what? The customer. So this is amount received from the customer. Are you following? And it says we should explain how the transaction be what? Accounted for. So when the question says you should explain how the transaction be accounted for, you have to write some English, right? So you just state that maybe according to or per IFRS 15, this performance obligation over time, right? And therefore, revenue should be recognized based on the progress. Okay. So just say something small, and then let's put our figures down. So we said the first thing we do is, don't forget, we test for overall profit or loss. Why are we testing for overall profit or loss? To check if there's onerous contract, right? And I told the treatment will be very different if there's onerous contract or if there's overall profit and overall contract loss. How do you do that? We said we bring the contract price. Okay. What's the total contract price? It's 10 million. So let me just write my 10 million. Total cost. Total cost will be cost to date plus cost to what? Complete. So total cost is the 6 million cost to date plus the 6 million cost to complete. And that gives us what? 12 million. Okay. So you see that here there's overall loss. There's a loss. There's overall loss. Are you following? Of 2 million. There's overall loss of what? 2 million. Okay. So if there's overall loss, then we said the contract is what? Onerous. Are you following? Now, if the contract is onerous, the treatment in the P&L will change. Okay, so when we get to P&L, we'll look at it. So we said there's overall loss. So this is an onerous contract. Step 2, we measure the progress. How do we get the progress? Here, they said which method are they using? Is it Latifa measures here progress towards completion based on cost incurred. So immediately say cost incurred, that is the input method. Okay, so the input method uses cost incurred. So with the input method, it is cost to date. Okay, cost to date divided by what? Total cost times 100. Cost to date divided by the total cost times what? 100. So what is our cost to date? We're told that 6 million, right? Divided by total cost 12 million. That's the 6 million cost to date plus 6 million cost to complete. Then by 100. And that will give us a figure of like 50%. Okay. So 50% is our what? Our progress. Then let's go to step 3. Step 3 is we are going to record items in our P&L account, and step 4, financial position. So step 3, revenue as usual. Asia revenue, right? How do we get the revenue? We said the revenue will be the progress, which is 50% by what? The total contract price, which is 10 million. Are you following? So 50% of what? The 10 million. And that will give us what? $5 million. And then we go to cost of sales. We said with the cost of sales, we just pick the cost to date, okay, which is what? 6 million. So we pick cost to date, which is 6 million. Now, if you deduct, what do you get? 5 million minus 6 million. We have a loss of what? 1 million. So we'll be recording 1 million in our books. But see, I said this is what? Onerous contract. The stance is okay. If there will be onerous contract, okay, or if the contract is onerous, there's overall loss. Here we have 2 million overall loss. The standard says we should record all the loss immediately, or we should record all the loss the first time we are recognizing what? Revenue. So if you look at step three, what we've done here, 5 million minus 6 million will give us what? 1 million. Are you following? So we would have recorded only 1 million what? Revenue. And sorry, we would have recorded only 1 million what? Loss. But the standard says, okay, if you have overall loss and you are recording the loss in the first, in your, I mean, for the first time that you are recording revenue, the first time you are recording revenue, record the whole loss. Are you following? So when we subtract 5, when we do it 5 minus 6, we have 1 million. But the total loss is 2 million. Are you following? So we have to record extra loss of what? 1 million, so that we can cover all the 2 million loss. Are you following? So we have something called extra loss, which is also called provision for onerous contract. So we have so many names, either extra loss or provision for what? Onerous contract, or just normal what? Provision. Okay. So I'm saying we have to record extra 1 million. Okay. So that now if we are done recording the extra 1 million, when we do it now, our total loss will now be what? The 2 million. So it means we have recorded all the 2 million in year one. We will now record all the 2 million loss in year what? One. Are you following? Huh. So that's how we go about this. Okay. That's how we go about this. So you underline this one here. So we had a loss of what? 2 million. So that's how we do it. Let me go over again. I'm saying revenue is the same, 50% of what? The contract price, which is 5 million. Cost of sales, we go and pay cost with it, which is what? 6 million is in the question. If you subtract 5, if you make it 5 minus 6, you get what? 1 million as the loss. I follow. So we have recorded a loss of what? 1 million in our books. We have recorded a loss of what? 1 million in our what? In our books. But I'm saying, okay, the start is saying if there's overall contract loss, we have to record the whole loss. From step 1, the overall contract loss is what? 2 million. Are you following? So we have to record all the 2 million. So I'm saying 5 million minus 6 million gives us what? 1 million. We have to add extra loss of what? 1 million. So that our total loss will be what? 2 million. And that's the difference here. That's the extra loss of what? 1 million. So that our loss will be what? 2 million. So that's how we treat onerous contract. Don't forget, if there's overall contract loss, that's how we treat it. Then step 4, let's go to the statement of financial position. We say the statement of financial position, you have something we call contract asset or contract what? Liability, and contract receivable what? Payable. How do we get contract asset or contract liability? We said we pick revenue what? Recognized. If you remember, we looked at it in the previous video. Revenue what? Recognized. Okay. How much have we recognized for the first time? 50 million. And the revenue recognized is to date, not revenue recognized for only 1 year. So from the time you started recognizing revenue, from the time you started what? Recognizing revenue in your books, how much have you recognized so far? So you've recognized revenue of what? 5 million. Are you getting it from here? The P&L account, the 5 million. And then we are going to compare this with what? The amount billed. Amount we are billing or invoice the customer. Amount billed. How much is the amount billed? The one that we've received from the customer. We have received how much? 3 million from what? The customer. Okay. So we deduct, and then there's what? Contract asset. Contract what? Asset. And this will be recorded in the statement of financial position. How much is the contract asset? If you deduct this, you get what? 2 million. So 2 million is a contract asset that will be recording in the statement of financial position. So here the amount we received from the customer is the amount we bill the customer. So we assume that, okay, we bill the customer 2 million. Sorry, we bill the customer 3 million and receive 3 million from the customer. Okay. So here in this question, we can't find contract payable or receivable. We said with the contract payable or receivable, we compare the amount billed with the cash received from the customer. Here we've been told that we received 3 million from the customer. So we have only amount received from the customer. So the assumption is that, okay, the amount billed, the 3 million we bill the customer is the 3 million that we are receiving from what? The customer. Okay, so amount billed is equal to amount what? Received, which is 3 million. So here we assume there's no contract receivable or contract what? Payable. And also in the financial position, if you remember the extra loss, I told you will be a liability, we call it provision. So you also have to record that in your financial position. Don't forget that provision that will also be recorded in the financial position. How much? 1 million. We made provision for extra loss of what? 1 million. And this provision will be a liability, current liability, current liability. So don't forget this provision here, this 1 million here, we are going to record it in our books as current liability. The provision from this side, the one from the P&L account, this 1 million extra difference that we recorded, right? Okay, so that's question 3. Let's look at question 4. So let's look at question 4. Question 4 says, on 1st January 2023, so let me write example 4. On 1st January 2023, my dad entered into a contract with a customer to construct a specialized building for a consideration of what? 2 million. So the consideration is what? 2 million plus a bonus of 1.4 million if the building is completed within what? 18 months. If the building is completed within what? 18 months. Estimated cost to construct the building were what? 1.5 million. This estimated cost to construct the building. So that's the total cost. Not cost to date, not cost to complete, the whole cost. If the contract is terminated by the customer, my dad can demand payment for the cost incurred to date plus a markup of what? 30%. On 1st June 2023, as a result of factors outside of its control, my dad was not sure whether the bonus would be received or achieved. At 31st December 2023, my dad had incurred cost of what? 1 million. So this 1 million is the cost to date. Look at the year end, 31st December 2023. And we're told that at 31st December 2023, they've incurred 1 million cost. So the 1 million is cost incurred to what? Date. So the difference between the 1 million and the 1.5 is the cost to complete, which is 0.5. They were still unsure as to whether the bonus targets will be met. My dad measures progress towards completion based on cost incurred. At 31st December 2023, my dad had received 1 million from the customer required. How should the transaction be accounted for in the year ended 31st December 2023? So here, you have to say something. You can do some small explanation. Okay, we had variable consideration here. If you remember, the bonus is the variable consideration. How much is it? It is what? 0.4 million variable consideration. And it says that will be received only when they're able to finish building within what? 18 months, right? But if, as we read the question, we realized that they were not sure. Okay, this is as a result of factors outside their control. They are not sure if they will meet the target, right? So we are not going to record a 0.4 million. We looked at this in the previous videos, right? Variable consideration. We only recognize them when the entity is sure that they will meet the conditions, and that a significant reversal in the amount of cumulative revenue recognized will know what occur. So we only record the variable consideration if they are sure they will meet the target. Here it says they can't, so or they are not sure, so we are not going to record the 0.4. So we are going to record only the 2 million main what consideration. And then with the 30% markup, we also told that if the contract is terminated, then my dad can demand for what? Their cost they've incurred to date plus what? A markup of 30%. After reading the question or reading the question, there's no way, it's not stated that the contract will be terminated by the customer. Are you following? So my dad would demand the payment plus 30% markup only when the contract is terminated, only when the customer what defaults. Are you following? When the customer terminates the contract, that's when my dad can what? Demand for payment plus the markup. Here too, we've not been told that the customer has defaulted. I follow. We've not been told that the customer has what defaulted. And so with that we are not going to do anything with that. The 30% markup and then the my dad demanding payment for cost to what date. We are not going to touch it because we've not been told that the customer has defaulted, right? Or the customer has cancelled the contract. So we are not going to do anything. So we are not going to touch the bonus of 0.4 and then the 30% markup too. We are not. Okay, so that's it. So you can explain this per IFRS 15, the 0.5. We said the 0.4 is a variable consideration. We explain why we are not going to record it. I have also explained why the markup 2, we are not going to touch it, right? Because the customer has not terminated what the contract or has not defaulted. So step 1, overall contract, very, very important to check if there's honest contract. So overall profit or loss, overall profit or loss. How do we get the overall profit or loss? We said we compare contract price. So what's the contract price? Our contract price is what, 2 million, only 2 million. Then total cost is 1.5 million. Explain to you that's 1.5. Okay, the 1 million is the cost to date. So you deduct and you have overall profit. Okay, so we have profit of 0.5 million. So with this contract or with this yes, so with this one here, there's no onerous contract. Here, there's no onerous contract, right? With example 4, there's no onerous contract. Okay, then step 2, we have to look at our progress. So step 2, our progress, which we said is equal to, so here, which method are they using? Is it input or output? It's here, it says my dad measures progress towards completion based on cost incurred. So they are using input, cost to date. So we said it is what? Cost to what? Date divided by what? Total cost times 100. And then what is our cost to date? The cost they've incurred to date is 1 million. It's in the question. It's here. I've done it 1 million. So here it will be 1 million divided by total cost 1.5. Total cost is 1.5. Okay. Then multiply by what? 100%. Okay. And that will give us 1.5, 1 million divided by 1.5 times this. It gives us 66.67%. Okay, 66.7%, or we can just make it 2 over 3, maybe to get a fraction, or 2 divided by 3, okay, or 2 out of what? 3. So that's our progress. And then step 3, we are going to record revenue. So how much do we record as revenue? So our revenue will be our contract price. How much is it? 2 million. Okay. So it will be the 66.67% or the 2 over 3 by the 2 million. Okay. So 66.667%. You can just make it 67%. It doesn't matter. Okay. You can use only two decimal places here. By 100, by what's the total contract? Okay, by 2 million. That's changing anything. Just do it your own way. You can even use the 2 over 3 times what? The 2 million, because 2 over 3 is the same as 66.67%. Okay, but here we took the percentage away and just 2 over 3. So when you do it, you get 1.333 million. Then we go to our cost of sales. Okay, and then we said with the cost of sales, we pick the cost to date. What's our cost to date? 1 million. Okay, so when we deduct 1.333 minus 1 million, so we are going to have a profit of 0.0.33, no, sorry, 0.333 million. Okay, so this is the profit we are going to record. Don't worry, you can even you can even write the answers in full, like this 2 million. You can write 2, then 1, 2. You can write 2 and 6 zeros. This 1.5, this total cost of 1.5 million. You can just write 1 million and 5. You can just write them in full, like add the zeros. Okay, or you can put 3 zeros up and work with 3 zeros. It's fine. Okay, but hear me, the questions are given in 2 million, like 2 and then 2 million. So I'm also working with that. But any way you do it, you're fine to go. Then let's go to step 4. Step 4, we said we are going to look at what we are going to record in our financial position. And we said with that one, we record only the contract asset or contract what? Liability. Okay, so that one, we bring revenue recognized to date. I keep saying to date because we'll be solving complex questions along the line, maybe drawing the question and answer section. Okay, so revenue recognized, revenue recognized. So if you come to the P&L here, revenue recognized is what? 1.333. Then how much have we billed or received from the customer? So amount billed, which we said here is the same as what? The cash received from the customer. We bill the customer 1 million, which is here, this figure here, this 1 million that we have received from the customer. That's what we are using as the amount billed. So here, to when you deduct, you get the same thing, contract asset. We get a contract asset of 0.333 million, right? So that's how we go about it. So this is our contract asset, contract asset, which we are going to record in the statement of financial position. Okay. Okay, so that's it with question 4. With question 4, I was saying that if we're using the old method here, the contract asset here, you see here we brought revenue recognized. We brought revenue recognized here. This place, revenue recognized here, right? And we less amount billed. Would have made it, would have brought cost to date first, would have added profits before less than the amount billed. So if I use the old method, it would have been like this. The revenue is the same 1.333. Our cost to date would have still been 1, right? And then we are going to less the amount billed. So I'm saying, okay, if you're using the old method, okay, our cost to date is what? The 1 million. Then we add the profit, 0.333. Then we less amount billed. We would have given us the same answer here because here we are using the cost method to measure progress, right? By some instances, it won't be the same. Okay, so this is it for question 4. Okay, so let's check question 5. Now with question 5, okay, let's solve question 5 in a question and answer session. Okay, there will be one session for question and answers. Okay, so there will be one more video on Ifrs 15 where we are going to solve questions, a bit complex questions. Not really complex, but like we'll select like 8, 9, 10 complex questions and then look at them. Right, so let's add this one to it. Okay, yeah, so we'll look at this one. We'll look at question 5 during the question and answer session. Okay, now let's continue with some other areas in IFRS 15. So we have other areas. Okay, we have other areas. One area is principal versus agent considerations, right? So how does the principal recognize revenue, or how much does the principal recognize as revenue, and how much does the agent also recognize as what? Revenue, right? So it says when an agent. Okay, when an agent satisfies a performance obligation, it recognizes revenue in the amount of fee or commission to which it expects to be entitled to or to be entitled in exchange for arranging for the principal to provide its goods or services. So we are saying that agents, they record only their commission or fee as revenue. So you receive goods worth 10 million from your customer, you are taking 1% as your commission. 1% of 1 million is what? Are you following? So just pick 1% of the 10 million. Pick 1% of what? The 10 million. And that's what you're going to record as your revenue. So as an agent, you only record your commission or your fee as your revenue. The remaining will be remitted to the principal. Okay. It says an agent might sell goods for what? A principal and collect the cash from the sale. The agent then hands the cash to the principal after deducting the agency fee. After deducting the agency what fee? Yes. So when you pick goods from your from your principal, you sell the goods, okay, for the principal. You deduct your commission and you make the remaining cash back to the principal. Are you following? So look at this example. The example I gave here. You sold goods worth 10 million for your principal. You sold goods worth 10 million for your principal, right? So we said 1% of 10 million is 0. What? 1. So I'm getting 0.1. Okay. Now equals 0.1. As an agent, you record only 0.1 as what? Revenue. Are you following? It was 0.1 as what? Revenue. Now you've received goods worth 10 million from who? Your principal. So what you do is, after taking your 0.1 million from the 10 million, you have 9.9 million. The 9.9 million cash should be remitted back to what? Your principal. So you pick your 0.1 million as your cash and as your what? Revenue. Okay. Then you remit the you remit the 9.9 million left after deducting your 0.1. Remit it, give it back to your principal, and that will be the principal's cash or revenue. That's what it's talking about. Okay. Then it says a principal recognizes the gross amount of revenue to which it's entitled for services and then goods what? Transferred. I've explained that. So that's all about principal and agent. Okay. The agent, when you receive the goods, you sell them, you will take your portion, your fee, your percentage, then you remit the remaining back to your principal. So you record revenue equal to your commission, and cash also equal to your commission or your fee. The remaining will be given back to the principal. That's all. Then we have sale with right to return, right? This all the following must be recognized when the product is sold with the right of what? Return. So you sell to your customers, and then your customers, they have right to what? Return, based on certain what? Conditions. Are you following? So it says when the sale with right to return, these are the things we do. Okay. She says we recognize the following. So we recognize revenue for the transferred product in the amount of consideration to which the entity expects to be entitled. That is, revenue would not be recognized for product expected to be what? Returned. So you only record revenue for the portion that is not expected to be returned. Let's say you sold goods worth 50 million to a customer. Okay. And you said, okay, the customer has the right to return, let's say, 10 million from, let's say, January to the following year. Okay, you've given the customer a particular time, okay, during which he or she can return the goods. So let's say you tell the customer, okay, from January you can return what? 10 million. Now, as at the time that you are transferring the goods, you are selling the goods, okay, even though the total value is what? 50 million, you don't have to record the 50 million. You have to record only 40 million. Okay. For the 10 million goods that the customer can return, you only record revenue when the condition elapsed. So let's say you tell the customer, okay, I said from January, you can return what, 10 million. But from June going, you can't return the 10 million again. So you only record the 10 million revenue after June, when the condition, after June, when the customer has no right to return it again to you. Till June, that the customer cannot return the 10 million, you only have to record 40 million as your what? Your revenue. With the portion that is expected to be returned, you don't have to record revenue for that portion. Okay. I think we'll do more of these things. Then we have a refund liability for the 10 million portion, and then an asset. Okay. And this is a corresponding adjustment to cost of sales for its right to recover products from customers on settling the refund what liability. Yes. So the customer has right to return. So you have an asset. If the customer should return the goods to you, you have an asset, your cost of sales. The customer will return the 10 million to you, and that will increase your what? Your cost of sales. Sorry. Yes, if the customer returns the goods to you, the customer will return the goods back to you. The goods you've sold to the customer will return them to you. So it will be an asset. You have inventory of goods. So it will be an asset. Are you following? I think we'll look more of these things later. Okay. So I just want to introduce you to the sale with right to return. Okay. So you only recognize revenue for the portion that the customer has no right to return. For the portion that the customer has right to return, you only recognize revenue when the condition is gone, and therefore the customer cannot return it again. That's when you record revenue. Okay, then we have repurchase agreements. So sometimes let me also summarize that for you. So this sometimes you can purchase good, or you can sell to the customer, and the customer has what? The right to come and purchase it back again. Are you following? So this a repurchase agreement is a contract in which an entity sells an asset and also promises or has the option, okay, to repurchase the asset. So you sell to the customer, but you have the option to what? Repurchase, to go and buy it back again. It says a customer does not obtain control of the asset when the selling entity has the obligation or the right to repurchase. So you sell to the customer, and you also have the right or the option to go and buy it back again from the customer. It says if that's the case, then the customer has no control. So the customer has no control over the asset, and you, the one selling, you cannot recognize what? Revenue. Are you following? It's like the thing is with you. You sold to the customer right, but the customer has right to do what? But you the one selling, you have the right to what? Buy back from the customer. So if you sell to the customer and you have rights to buy back from the customer, then we see there's a repurchase agreement. And we are saying that, okay, the customer can never obtain control. If that's the case, then the customer does not obtain control of the asset. And therefore, you the one selling, you don't have to record what? Revenue. Are you following? So that's a repurchase agreement, okay? And then normally repurchase agreement, they have what we call financing element. They may have financing what? They may have financing element, okay? So that's it. Is it the difference between the amount of consideration received from the customer, okay, and the amount of consideration paid to the customer is recognized as interest. Now, I'll use an example. There's an example down to illustrate that for you for better understanding. But what we are saying is that where we have repurchase agreement, what it means is that where we have repurchase agreement, what it means is that the customer, when we sell to the customer does not obtain control of the assets. Why? Because we have the right to buy back again. We can buy back whatever we are selling to the customer. So the customer doesn't have control, and therefore we cannot recognize what? Revenue, but we have to recognize what? Liability. Okay. Look at this example here. I want to just explain this thing to you, then move on. It says S Limited is in the forestry what business. It cuts wood and seasons for seasons it. Okay, it cuts wood and what? Cuts wood and seasons it for 3 to 4 years before selling it to furniture manufacturers. S Limited sells 1,000 tons of what? Wood to a bank for 1 million. S Limited has a contract under which it will buy the wood back from the bank in a year's time for 1 million, for 1,100,000. The wood will never leave X Limited's what promises. So this is a typical example of what sale and repurchase what agreement. This is the X Limited sold to who? Sold to what, a bank. Are you getting it for 1 million? But they have the right to go and buy back in a year's time for 1 million what? 100,000. It says the would never leave as limited promises. So it's like premises. So it's like you've sold, but it's with you. You have the right to buy back. So it says such agreement is called the sale with the right to what? Repurchase. And in that situation, we say we can never record revenue because one, the customer never obtains control of the goods. So we cannot record what revenue. We can't record revenue, but rather we have to record a liability. Are you following? So with the 1 million, this is what we do. We are going to debit our cash because we are receiving cash of what 1 million we sold. But instead of crediting revenue, we will never credit revenue. We'll credit what? Liability. Why are we crediting liability? Because the customer never obtained control of the good. Are you following? So it's like we just gone for loan. That's what it means. It's like we've gone for loan. That's all. So we can never record what revenue. Then it says we'll buy it back in a year's time with an amount of what? 1 million at an amount of 1,100,000. So the difference between the 1 million and 1,100,000, that's the 100,000, is the interest. Are you following? Is what? The interest. So when the year is up for us to buy back, okay, then what do? This time we are buying back. So we have to credit our cash, okay, and then we will debit the liability to remove it from the books, okay. But here at the year end, there will be an interest. The difference between the 1 million and 1,100,000, there will be an interest, and that interest should be recorded as interest what? Expense in the books. Okay. Very, very good. Very, very good. So that is it. I mean, it's something small. There's more to it. I just want you to understand the sale with sale and repurchase agreements. That if there's such agreement, then we can't record revenue because we never sold. The customer has not obtained control of the items. So it's like we've never sold. Then bill and hold to something like that. Sometimes you sell to the customer, but you still have the items in your premises. Okay, this time the customer is you sell to the customer. You are not going to buy back, but you sell to the customer and you still have the goods in your possession, in your premises, on your premises, right? So bill and hold is nothing difficult. You just have to determine if the conditions for control are met. If the conditions for control are met, okay, then you can record revenue. So ask yourself, has the customer obtained control of the asset? Has the physical possession, has it been transferred to the customer? Right, and risk and rewards, has it been transferred to the customer? If the conditions of control are met, then you can record revenue. Okay, so sometimes an example is where the customer has no space in his or her shop. So the customer buys from you and tells you to hold the goods or keep the goods for him or her. Okay, it's bill and hold. Okay, so for bill and hold, just determine if the conditions for control are met. If the conditions for control are met, and you've determined that the customer controls the goods, they record revenue. Other than that, you record liability. You've never sold, so you record liability. So we have examples here. Then consignment too. We have consignment inventory, consignment sales. Okay, so there's more to look at, but we've covered almost everything under IFRS 15. We'll just look at this one's areas more in details some other time. Okay, bill and hold, consignment and stuff, right? So let's draw the curtains on IFRS 15 here. We will continue and look at the other standards. But before we look at other standards, we are going to have the question and answer session. There will be one video for questions and answers. As I said, we are going to have a bit complicated questions. Okay, probably ACCA questions, ICG questions, ICANN questions, CFE questions. We are going to look at a bit complicated questions to try our understanding on IFRS 15, and that'll be in one video, a separate video. Okay, so you just check that video and then practice more questions. Like I said, the questions will be a bit tougher, not really tough, but a bit more complicated, right? To test understanding, we really have to test understanding and make sure we understand. So that's it with IFRS 15, revenue from contract with customers. So I'll see you in the next video.